Stock market new high, Bitcoin multi-month lows, silver deja vu 1980. I quantified that and more in today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome back. I'm Dave Bush. This is the All Markets Report where I quantify across asset classes with an eye to the week ahead. And what a week last week was. We have a lot to talk about. I'm going to quantify what I think is most relevant for the week ahead and beyond. Let's get into it. Time for this week's key themes, and number one is equity risk appetite remains strong. The S&P 500 just hit an all-time high, and this coming week we've got two more Mag 7 earnings releases from Google and Amazon. I'm going to quantify how they typically perform after earnings, and we can look for trends. And I threw in a often high-flying tech darling as well. I'll quantify how it performs after earnings. It reports Monday after the close. Stay tuned. Second theme of the week is speculative liquidity tightens. As stocks hit all-time highs in many cases, Bitcoin just hit a multi-month low. So is the stretch percent, which is noteworthy right now, is it at an extreme or does it have further to go? I'm going to quantify it, of course. Metals testing historical extremes. I'm going to put silver in focus. And is it 1980 deja vu or is it not even close? Credit shows no fear, at least yet, so I'll put a yield spread in focus. And last but not least, the dollar bounced this week after hitting a one-year low. So I'll take a look at 12-month lows in the DXY, US dollar index, and quantify what's likely ahead for the greenback. I'm going to start with an update on crypto this week because Bitcoin's price action was so noteworthy. Now, here we've got Bitcoin on a daily chart, and as I record this, it was recently 12.5% below its 20-day moving average. I measured that with an indicator I created called the stretch percent. You can see at the bottom of the chart, this orange indicator shows the stretch or the distance was negative 12.5%, meaning below the 20 MA. So how is this performed with a 30-day hold, 60, 90-day hold in the past? And let's take a look. Here we have stats for Bitcoin with a 30-day hold with this singular condition. And you can see on the left-hand side, total P&L looks very robust, over 600%. Drawdown, if you were trading this as a system, would be quite steep and unacceptable to me. 41 instances, so this has happened many times before, and the hit rate or profitability is north of a coin flip, but not by much, right? 56.1%. Profit factor, certainly good at 1.787, and yet the trades here are pretty lumpy. You can see in 2017, a couple very robust bounces from this stretch percent level within 30 days. You can see the same in 2020, and you can see probably this is 2021. So pretty lumpy or concentrated gains here for the most part with this stretch percent level and a 30-day hold. Let's look at 60 days, and we see total P&L is much greater, so that speaks highly of a 60-day hold. And drawdown still quite steep, but not as steep, 34 instances. And profitability does improve here, 64.71%, which is 22 out of 34 historically. Profit factor, 1.6. It slipped a little bit, but still solid. Let's look at 90 days, and you can see total P&L still robust, but it's down from 60 days. Drawdown is massive now over a 3-month window. 38 instances, and the profitability, it's about the same as 60 days, a little bit lower, 63.16%. Profit factor also takes a little bit of a hit. So we see a little bit of erosion. Now, what if stretch percent were just stretched a little bit greater? That's something we could certainly conceivably see in the coming week, so I wanted to measure it. So here we have the same idea, 30-day hold, but now Bitcoin historically stretched 20% or more below its 20-day moving average. Now, total P&L with a 30-day hold is 581%. Drawdown still steep, 19 instances now because we have a greater stretch degree level. We're going to have fewer instances, therefore. Profitability, though, is much stronger. 73.68% of the time, historically, it's been higher 30 days later. And profit factor, very robust at 2.732. Let's move out to 60 days, see what happens. And total P&L definitely gets slashed here, only 65.91%. There are only 14 instances, drawdown still steep, and it is a coin flip in terms of this greater stretch percent and a 60-day hold. Profit factor is north of 1, which is break even, but not hugely, 1.303. 90-day hold and a 20% stretch level, we can see total P&L is back up a bit. Drawdown is massive. And total trades only 20. Profitability is 70%, 14 out of 20, and profit factor is certainly decent, 1.9. So with a 20% stretch level, the 30-day hold window was stronger, meaning you're getting, historically anyways, a strong snapback response a lot of the time, but the longer hold windows with the deeper stretch percent, 60 and 90 days, is not quite as good. Now, what about back to the 12.5% stretch, but add in another condition, which is Bitcoin closes or ends at a 250-day low. There have only been 8 of these instances, and these are the conditions we just had within the past few days. Total P&L with a 30-day hold, and that's all I'm going to look at in this particular case, is just 5.4%. I mean, that's almost noise with Bitcoin. Drawdown is still pretty steep, although not what we saw earlier, but we have fewer instances here. Coin flip in terms of profitability, 50-50, and profit factor is barely north of 1.0. So a little bit of concern that we just did meet these conditions over 30-day hold time. It really doesn't look super robust, to put it mildly. It's flattish with a lot of risk. Let's turn to the stock market, and it's still earnings season. So I'm going to use my earnings performance analyzer app, not yet released, stay tuned, and start with this week's mystery stock, which is Palantir. Now, this reports Monday after the close, and we see here stats for its post-earnings one-day return or price performance. So historically, going back those 10 years, average one-day return, positive 3.89%. That is a very large one-day post-earnings return for an average number compared to a lot of earnings that I see. So I suspect that'll go down over time. Of course, we'll see if I'm right about that. The hit rate or win rate is 50%, up half the time, down half the time one day later after earnings. Best performance, positive 30.8%. Worst performance, negative 15.11%. And the average gain is 14.3%. Average loss, 6.51%. Median gain, 10.38%, median loss, negative 6.37%. Let's look at the trend 1, 5, and 10, and also 30 days later, actually. One day we already covered, right? Positive 3.89%. 5 days later, the average return, positive 9.84%. Wow, it's a 5-day return. 10 days later, positive 11.33%. And amazing, 30-day is positive 18.87%. So this has a really powerful historical post-earnings trend. I suspect all of this will come down a little bit over time. Now let's turn to a couple of those Mag 7 companies reporting. We see Google, and this reports Wednesday after the close. Its average one-day return is 0.19%. Profitability is north of a coin flip, 53.8%. Its best one-day return, 10.45%, worst is negative 7.70%. And the average gain, positive 2.91% on 21 instances. Average loss, negative 3.17%. And median gain, positive 1.66%. Median loss, negative 2.56%. So obviously you see that skew where the average loss and the median loss exceed the average gain and the median gain here. But there is that positive win rate of 53.8%, almost 54%. So you do eke out a slightly positive average one-day return, which is where we started, 0.19%. Let's look at the historical trend over 1, 5, 10, and 30 days. Let's start right away with 5 days, which is negative 0.23%, but you move out to 10 days, 0.38% turns positive, and 30 days later, very positive 2.2% post earnings. Now we have one more, which is Amazon, and its average one-day return is 0.09%. By the way, Thursday after the close is when Amazon reports. The win rate is below 50%, 46.2%, I should say. Best performance, 13.54% post-earnings. Worst performance, negative 14.05%. Average gain, 6.10. Average loss, 5.06. Median gain, 6.83%. And median loss, negative 5.14%. The trend, same windows of time you see. 5 days is 0.31%. Much better. 10 days, 1.14%. And 30 days also improves 1.86%. Time for commodities, and as mentioned, I'm revisiting silver, and we see silver futures here on a monthly chart, once again with the stretch percent, but this time on a monthly basis. So again, let's go back to January 1980, that extreme that lasted for decades, put in a high at that point. That stretch percent was 216% above its 20-month moving average. Now, fast forward to last week, it did not close at that degree of stretch, but intra-week, it was stretched 207% above its 20-month moving average. Very reminiscent of that extreme peak that put in the top in January 1980. So will that be a repeat? Will this be a peak that lasts decades? I suspect not. I suspect that silver may be able to take it out. I've got some studies we've done in recent videos, but definitely noteworthy to point out that this stretch percent extreme on a monthly basis is very similar to a major peak, the most major peak in modern times for silver of January 1980. Time for a credit market update. And I've got a daily chart here of the 10-year, 2-year yield spread. And in fact, this just moved up right off its 50-day moving average as the Federal Reserve, or the FOMC, held steady on rates. The market here, in part, is anticipating further easing. And there are a lot of reasons for that. Of course, we now know the next Fed chairperson or chairman is going to be Kevin Warsh, who is looking for regime change, or at least he said that in the past, at the Federal Reserve. So we'll find out what that means in time. But basically, this is absent of fear. This is bull steepening. And again, anticipatory of further easing in the months to come. Time for a macro update, and I'm going to revisit the US dollar index, which just did yet again something new last week, hitting a 1-year or 12-month low. You can see that very vicious swing to the downside, capped by an expanded range bearish candle, and that brought it to the new 12-month low. So how does the dollar index fare historically from around 1970 to the present when it does this with various hold times? So let's start with a 1-year low, sell 90 days later scenario. And you can see the total P&L left-hand side is negative. The equity curve for a moment, look at those red connected dots. That is steeply negative and underperforms the blue buy and hold line. So new lows beget more poor performance, underperforming buy and hold for the dollar 90 days later. 46 instances of this. Profitability is only 30.43%, so very strongly trending to the downside historically. Profit factors in the basement, 0.291. What about a 180-day or roughly 6-month hold? You can see it's a little bit better than buy and hold here, but still negative, not by much. Total P&L, that's total for 32 instances, is basically flat, negative 1.32%. Profitability is still below 50%, and profit factor is basically flat. It's just below 1. What about with a 1-year hold? And this is back below the buy and hold line. Total P&L is negative, 27 instances historically from early 1967 to be exact to the present. Profitability, 48.15%, a little bit closer to 50-50, but still below it. And profit factor is decently below 1 here. So any way you slice it, or at least with these scenarios, it is negative. And so I would expect that trend to continue. All right, folks, that's it for today's All Markets Report. Of course, Thursday, I will have my next Edge Report. That's where I quantify edges or opportunities in specific stocks, coins, tokens, commodities, and more. And have a great week. I will see you in my next report.